This is Lance Knaack, Associate Financial Planner at Syverson Strege, and this is today's Finance Moment. Mutual funds and exchange-traded funds, or ETFs for short, have many similarities and some differences. Syverson Strege uses both for investments, and you may be curious to know the difference between them. A mutual fund is a company that brings together money from many people and invests it in stocks, bonds, or other assets. The combined holdings of the fund are known as its portfolio. Each investor in the fund owns shares which represent a part of these holdings. When you buy or redeem a mutual fund, you are transacting directly with the fund. Mutual funds first came into existence in the 1920s. Like mutual funds, ETF offer investors a way to pool their money in a fund that makes investments in stocks, bonds, or other assets, and in return to receive an interest in that investment pool. Unlike mutual funds, however, ETF shares are traded on a national stock exchange and at market prices that may or may not be the same as the current market value of its underlying investments, known as the net asset value of the shares. ETFs came into existence in the 1990s. Both mutual funds and ETFs can be actively and passively managed. ETFs are more well known for following indexes, but more and more are being actively managed. Many mutual funds also follow indexes, but there are larger numbers of mutual funds that are actively managed. Many of these actively managed funds specialize in certain areas of the market. Probably the biggest difference between mutual funds and ETFs is how they are bought and sold. Mutual funds are bought and sold at the end of each trading day. ETFs can be bought and sold throughout the market day. The ability for an ETF to be sold during the day and having an instant price realized is the biggest reason that ETFs are gaining popularity over mutual funds. The other big reason is that ETFs tend to be more tax efficient. Due to the more complicated way that ETF shares are exchanged behind the scenes when bought and sold, they very rarely distribute capital gains. This is unlike mutual funds that must from time to time distribute the capital gains that have accumulated inside of the fund from the growth of the underlying investments. These capital gain distributions are often unwelcome by investors because they are taxable and can come as a surprise at the end of the year. In summary, both types of investments have a place in the market and in Syverson Strege portfolios. However, the trend toward ETF investments is likely to continue due to their increased liquidity and tax efficiency. If you have questions, please reach out to your financial planner or associate financial planner. Visit Syverson Strege online at onlyworkforyou.com or call us at 515-225-6000.